The recession is canceled, or is it? And that's the big question we've got to talk about now, because now there's a big debate going on Wall Street about, are we going to experience a hard landing, a soft landing, or no landing at all? That's what's being debated by economists now, and the Fed's mouthpiece, Nikki T, is adding some insight and some commentary into it, and we'll analyze that as well as providing more perspective. But first, we got to look at what JP Morgan has to say, and JP Morgan isn't very excited. JP Morgan suggests that disinflation that we are seeing in markets now might end up just being transitory, which this is basically egg in the face of the Federal Reserve. It's the idea that, hey, Federal Reserve, y'all thought that inflation going up was going to be transitory, and what ended up happening? It ended up skyrocketing and lasting a whole lot longer and being a whole lot bigger than you thought it was going to be. And while that might be what every woman in America wants to hear, it's not what we want to hear in economies. Now you've got folks like Marko Klanovic over at JPM suggesting, hey, wait a minute. Now you're arguing we're seeing disinflation, Mr. J. Powell? Yeah, well, we think your disinflation might end up being transitory. And this next upcoming CPI report could show us how transitory it ends up being, that disinflation. In other words, right back to inflation. And JP Morgan, of course, picks up on this idea that jobs growth is pouring cold water on the idea of a soft landing, that ultimately jobs growth is reheating the economy. They also suggest that 68% of S&P 500 companies have beat EPS estimates. Now, while that's lower than the long-term average of 75%, it's still pretty good. It shows things aren't actually as bad as it seems. And wage growth, while it seems to be tentatively moderating because of higher job openings, PMI starting to rotate back up again, and reports from earnings showing that maybe things aren't that bad, maybe we might end up having to crimp the economy substantially further, which this is basically JPM arguing, hey, you've got a situation right now where, look, you might end up having a Fed that has to tighten a lot more than they think, while at the same time companies are choosing, well, do we lay off people or continue to see margins suffer? Because margins are the big buffer right now. And JP Morgan suggests, in their belief, the stock market is going to end up hitting an air pocket in Q2 or Q3. This is all in reference to kind of like the soft landing idea. And it's basically suggesting, hey, if the plane comes in for a soft landing, that's one thing. JP Morgan thinks we're still flying, but we're going to hit an air pocket and kind of fall in like a sort of turbulent pattern in Q2 and Q3. And the reason we're going to do that, in their opinion, is because the Federal Reserve is likely to hike more aggressively. And that is going to end up hitting earnings and especially stocks a lot more than individuals are expecting. In fact, JP Morgan throws cold water on this idea that, hey, look, we broke the 200-day moving average. There's a golden cross. We've got all these technicals suggesting to potentially the beginning of a new business cycle. And what does JP Morgan say? No. We are not at the beginning of a new business cycle or economic cycle. We are actually at the tail end of the current crash. And that actually means there's more pain to come. And this idea of a soft landing is nonsense. Well, to counter this sort of bearish view from JP Morgan that the soft landing is nonsense and that things are going to get worse, and if anything, we should actually be looking at a hard landing. Now, to counter that, you actually have this idea of, well, maybe we shouldn't be talking about a landing at all. And this is what Nikki T has been tweeting. He posted this article being published in today's print. Actually, my newspaper should be sitting on my front lawn right now. I'm a big fan, by the way, of reading print, but I'm also a fan of reading digital. I do both. And the print is great because you don't miss anything, right? I actually saw Charlie Munger's op-ed in print, and I'm like, this is so cool, just because it feels old school. But anyway, so hard or soft landing? Some economists say neither if growth accelerates. Now, this is very interesting because you have JP Morgan suggesting we're going for the hard landing. You've got technical analysts suggesting, no, we're going for a soft landing because we broke the 200-day moving average and the numbers just aren't that bad. Companies aren't missing that terribly. So, well, what does Nick T say in his article, and where can we add some perspective? Well, he says the following. Surprising strength in hiring and consumer spending last month, together with signs that demand for autos in the housing market might be stabilizing after a decline, now have some economists pointing to a third scenario that seemed improbable just a few weeks ago, an actual economic growth upturn. In other words, a no landing scenario. Now that's really interesting because everybody's been talking about a landing, and now there's talk about what if there's just no landing at all? What if we don't actually have to land the economy? What if we just keep on flying? Could be fantastic. Now auto prices have moved up, but it's worth noting that mortgage rates, which somewhat potentially signals a bottom in the used auto market, but this idea that the housing market is picking up, I think is a little bit of clickbait because unfortunately, even though mortgage rates fell in December, look just on screen now here at the tick up that we're seeing in mortgage rates going into February. They're ticking right back up. At a 740 credit score, you're still sitting at nearly 6.5% at 6.44 for a 30-year fixed rate mortgage. That's not necessarily conducive with a housing market that's going to pick up again. If anything, it's conducive with a housing market that's going to fall again. But anyway, let's keep going and add some perspective for this idea of a hard or soft landing. So here's an individual who talks about there's a huge reluctance to admit the obvious, which is this idea that the economy is re-accelerating full stop, says this particular individual from the research firm Renaissance Macro. Now, this is the idea that, look, people gaining jobs is actually a good thing. Remember Jerome Powell's dual mandate. His dual mandate is stable prices and maximum employment. If we have stable prices, he does not need to force a recession. That is very important to remember. Jerome Powell does not need to force a recession and create unemployment as long as we do not have the symptoms of a wage price spiral, which so far, it doesn't look like we have the symptoms of a wage price spiral. If anything, it's becoming easier for companies like Starbucks and Walmart and Chipotle to hire individuals. And as you saw with Lyft and Uber, there's been a massive rise in the number of people willing to drive. 36% increase at Uber, and as Lyft calls it, an extreme increase in the availability of labor at Lyft, leading to a reduction of prices, leading to a reduction in peak pricing, leading to a reduction in margins for companies like Lyft. Now, moving on, there's some talk about here how the Federal Reserve has raised rates at the fastest pace since the 80s. And while wage growth slowed in January, there was an increase in hours worked, which kind of implies this idea that, hey, maybe no wage price spiral, but you're actually having an economy that's recovering a bit, which is good. Now, I think this still calls for patience in real estate because of the tick up again in rates. But you've got this idea now that what if we have no landing at all? Now, some people, like folks over at Morgan Stanley, respond and they say, well, the longer we fly, the longer we have a risk that we run out of fuel and we break something. I personally actually think, sure, it's possible we could have a black swan, but I actually think this analogy is kind of flawed, this idea that we have to come in for a landing at all. And it is true. If maybe we were coming in for a landing, but now we're doing a go around, or we're like, we don't want to land anymore. We're just going to hit the gas and fly again. Planes that are coming in for a landing, they can just hit the gas and take off again. Like they don't actually have to touch the ground at all. I think it's easy to forget that. And so this idea of constantly comparing the economy to a plane, it kind of suggests that, well, why didn't we run out of fuel in 2014 or 15 or 16 or 17 or 18 or 19 when the economy is just continuing to grow? In my opinion, we have to remember that work is basically fuel for the analogy of the plane. So the more the economy functions and grows, the more fuel it actually has. So this idea that we have to force a recession or land the economy, I think is actually a fair one to say that we don't need to. It is fair to say that maybe there is a no landing scenario at all. And that really we're seeing the biggest cushion come into play from margins at companies. And we'll talk about that in just a moment. But regarding the economy itself, we're now sitting at a 90% chance that we're going to hike rates to 5% by June. That's double that odd from 45% ago, just a month ago. And we're seeing more spending, right? We saw retail sales rebound, consumer spending rebound, Visa, MasterCard all reiterating this. Nick T apparently forgot that mortgage rates have already moved back up. And now this is an interesting one because Nick T doesn't provide all of the color that he should here. And this is where I always like to provide additional perspective. See, Nick T here mentions that Unilever, the maker of Dove and Ben & Jerry's ice cream, mentioned that revenue was up 9% in the fourth term, even as volumes fell and prices rose 11%. Pepsi talks about increasing sales prices as well. Well, fortunately, I actually have those earnings calls. And one of the things that I noticed going through these earnings calls that's very, very clear is that these companies, while they do talk about increasing prices, they talk about no longer being able to increase prices, suggesting that the consumer is burned out of price increases. Let's look at Unilever a little bit in detail, and let's look at Pepsi a little bit in detail. So what do we have over here? So we have volume being impacted more than expected. Volume was less than they would have modeled at these levels of price growths. And that's because they have experienced extraordinary inflation. This is Unilever. So it's important to know that, yes, these companies have experienced inflation. And there is still inflation in the pipeline. And that, yes, as China comes back, we should see potentially some pressure on commodities. But what does Unilever say here? Gross margin was down 210 basis points, reflecting the fact that despite stepping up pricing and landing higher delivery from our savings programs, we were very mindful of the pressure on consumers and chose not to fully offset the extraordinary level of inflation through pricing. In other words, they didn't have the big enough pee-pee to pass on all of the price increases. This actually shows you that even though you still have inflationary pressures, companies are realizing we can't keep raising prices. We can't keep raising prices because we don't have that big of a pee-pee. And this, in my opinion, is not a sign, as Nick T implies in his article, that, oh my gosh, these companies are raising all this pricing. That's where he stops in the article. But Nick, bro, you got to go a step further, man. You got to go a step further and analyze, is it possible that those price increases are done or that they're not actually a full price increase that could be made? And the answer to that is absolutely yes. The companies themselves are telling you that even with the increases, we are getting hit with margin. We are not able to fully cover the price increases currently. And even though we were able to cover a lot of them, we are not going to be able to continue doing that in 2023. In fact, Unilever is now talking basically about scamming people. Okay, I'm being a little facetious with that. But they're basically talking about, yeah, we're looking into our architecture for how we package products to basically try to pass on higher pricing while giving less product, right? When they talk about price pack architecture, that's what they're talking about. It's like your beer that was $10 used to be 12 ounces. Now it's 10.9 ounces, right? That's basically shrinkflation. And they're frustrated because they're realizing their margins are getting crimped. Listen to this quote right here. I'm literally reading it from the horse's mouth here. So that's a bit of a comprehensive tour on the last year characterized by high levels of pricing and pack price architecture and lower levels of promotion. That's 2022. This year, we will need some level or some list pricing and probably use mix more in 2023 than we have historically. In English, pee-pee down. We can't raise prices as much anymore. Volume is expected to be negative going into the next year because of price elasticity being limited. People have a limit to how much they are able to pay. And so you are seeing that limit show up over here. You're seeing PP falling. That is Unilever. But Nicky T didn't just mention Unilever. He also mentioned Pepsi. So what does Pepsi tell us? Because after all, Pepsi raised prices a lot, right? Well, let's go over to Pepsi and let's just briefly look at what Pepsi has to say for us. Okay, first thing we have right here is on inflation. I have a couple of comments on that. Number one, obviously, inflation is still out there as a factor for us. Partly, the fact that inflation is still high, it's not as high as it was before, but then the numbers are still relatively high. So we know this. In the food and beverages space and aerospace space, you still have lingering embers of inflation. We know that. We know that with certainty. But what do they talk about? Instead of raising prices, what does Pepsi talk about? This year, we really want to grow productivity. They literally say that. We're looking to drive a lot of productivity this year and put investments back into the business. And consumers are responding positively to this, but our expectation is to hopefully have margins in line with 2022. So listen to that for a moment. They're going to increase productivity in 2022, but have margins in line with 2022. In other words, their costs might be going up, but they're not able to pass those costs on to their consumers. Instead, they're going to increase productivity to preserve their margins. Think about that visually for a moment, okay? If the red line is pricing and the orange line is cost, on the left it's 22, on the right it's 2023. If the company is saying, hey, we want to have the same bottom line, which is the X. We want the bottom line to be at the same level, margin. If we want margin to be at the same level, and we're not increasing pricing, instead we're going to increase productivity to absorb the orange increase here, then we are preserving margin through more productivity, not by raising prices. That's what they're talking about here. We're not raising prices anymore. Or we're not able to anymore because people are starting to react negatively, right? That's a problem. So here's somebody who wants to ask about pricing and the higher range and stuff. They're talking about winning market share. They talk about how in the last 2 years there's been more pricing increases in the last 2 years. Obviously, we know that we've had a lot of inflation the last 2 years, so that's not a surprise. And then over here, we have revenue growth still growing at a healthy rate, and we feel good about that guide. And volumes, volumes might go down a little bit, but let's see how the year plays out. So, and they say right now the consumer's still quite good, but we're planning for multiple scenarios. So what do you have when you actually read the entire Pepsi earnings call? You don't have a company. And same thing at Unilever. You don't actually have a company that is saying, hey, we're going to keep raising prices. That's not what you have at all. So Nick T in his article is like basically ending the article by saying, still inflation. But the reality is these companies are out of steam. These companies, I'm going to write it down, are out of steam to raise prices. Instead, they're talking about productivity and volumes going down. That's what they're talking about. Productivity to preserve margins and volumes going down. They're also talking about packaging stuff differently to basically trick the consumer. I mean, that's just what shrinkflation is, right? It's a trick of the consumer. And so even though there might be higher input costs, they realize the ability to pass that on to consumers is limited. And I think this is something very important to remember, is that the Federal Reserve right now cares about CPI. Oh, sorry, I meant to say CPI. There we go. The Federal Reserve right now cares about CPI. They do not as much care about PPI. And the Fed's version of CPI is PCE, personal consumption expenditures. Anyway, this is important because these are very different. Consumer and personal is very different because it's the end product price. The end product price at companies, even like Unilever and Pepsi, or other companies like Starbucks and Chipotle and Whole Foods, the clothing companies, all of the companies that I'm reading about that sell stuff to consumers are like, we are tapped. We can't raise prices anymore. The only places I'm actually seeing price increases are like in aerospace or industrials and in some of these raw material inputs for producers. So we could be in a situation where, yes, you still have producer price inflation, but you don't have as much CPI or PCE. So what does that mean? Because you might ask yourself, but Kevin, But Kevin, if input costs go up, so in other words, if costs go up, the PPI goes up, how is it possible that CPI doesn't go up? Well, it's simple. It's the elasticity of demand puts a limit. There's a ceiling, and that ceiling is measured by CPI. But Kevin, if the producer price goes up, doesn't the ceiling have to go up? No, because people stop demanding the goods or the services if it goes up. So then who pays for it, Kevin? Simple. Margin. Margin go down. Profit at companies goes down. Let me make that even more simple. Earnings go down. And so this is where you can actually potentially go back to this JP Morgan article where they talk about seeing equities hitting an air pocket during Q3 and Q2. Why? Because earnings go down. Earnings go down, not inflation go up for consumers. That could actually potentially lead to the no landing scenario. So what does a potential no landing, recession is canceled scenario look like? Well, here's what it looks like. Throw that up on screen. A no landing scenario looks like the following. It looks like basically job growth, wage stability. So in other words, more people employed, but wage stability. It looks like consumer price stability. It looks like embers of inflation still coming through, but new embers not forming. It means earnings down, especially at food and staples. This is a red flag because if you have been investing in staples in 2022, you're probably going to see the margin impact in 2023. So that's something to keep in mind. So how do you potentially avoid that impact? Well, potentially you look for pricing power stocks. Where could those be? Maybe, and it depends how the economy moves. This could flip-flop, but maybe that could end up being in renewables if the economy does well. If the economy does poorly, and you actually do go into recession, renewables would probably do poorly. It's potentially in tech and AI. In stocks that have substantially been burdened, but now these companies have hopefully streamlined their margin a little bit by laying off, and maybe we go back to economic growth, and then generally these companies that have sold off over the last year would be the beneficiaries of that. Maybe, right? But it depends. So these renewables and tech AI would be great in a re-acceleration environment. If we actually do go into recession environment, this is the riskiest scenario because this is where you just ultimately have a sell down of everything, right? As we've seen over the last year. But anyway, the no landing scenario is actually bullish, in my opinion, for growth, renewables, and sort of a re-acceleration in that area, and not so great for restaurants and your more price sensitive areas. So, again, you're looking at evidence of this cap on pricing, even coming from Tyson Foods, right? Tyson Foods, like, yeah, look, some of our costs are going up, but we just can't raise prices anymore because our PP is getting small. Something important to keep in mind. Very, very, very important.